Number one, let's talk about taxation. LLCs, first off, we're going to compare LLC, S Corp, C Corp. So by default, LLCs are taxed as pass-through entities, meaning the profits and losses are going to be passed through to the owner's personal returns. If you have more than one owner, it's going to be a partnership. If it's a single owner, it's going to be considered disregarded. So if you ever hear the term disregarded entity, what they're really talking about is an LLC that is ignored for tax purposes. In other words, the owner is reporting everything on their personal return. But they're also very versatile. You can make them into an S Corp and a C Corp as well for tax purposes. LLCs are basically a Swiss Army knife of business entities. You get to choose how it's going to be taxed. You tell the IRS, here is how my entity is taxed. That's why so many practitioners love them, because they are so versatile. So to review, I could have an LLC that is ignored and it's just me. I could be a sole proprietor running a business with an LLC that does not file a tax return. It flows onto my personal tax return on my Schedule C. If me and somebody else are together in a business, then we're going to be filing a partnership return for that LLC, and it's going to give me a K-1 showing here's what portion of profits or losses flow down to me, and my buddy, it's going to give him or her a K-1 showing that portion of the profits. I could make an LLC taxed as an S Corp. I could make my LLC taxed as a C Corp, in which case it'll file the appropriate tax form as though that LLC is actually an S Corp, or as though it is actually a C Corp. So let's dive into those next two to make sure you understand the difference from a tax perspective. Number one, S Corps. S corporations are also pass-through entities, but they must elect this status by filing Form 2553 with the IRS. All corporations start as C Corps when they start, and you must elect to be treated as an S Corp. Those profits flow down to the shareholders of the S Corp. So those are the owners of that S Corp. They're called shareholders. Let me contrast that real quick, because LLCs, the owners are called members. So if you ever see that change of, you could have an LLC taxed as an S Corp, they're going to call it a shareholder when we're talking about taxes, because that's how it's treated. If it's an S Corp, just proper, regular corporation, taxed as an S Corp, shareholders, but the profits flow down to the owners. The C Corporation is very different by contrast. In a C Corporation, you have a flat tax, currently 21% on profits, and the corporate, basically that's called the corporate tax rate. If it takes the profits, so let's say a corporation makes $100,000 and it gets a flat 21%. It means I pay the federal government 21%. There may be state taxes as well, but I'm just talking federal tax for right now. It's taxed at that flat 21%, so there's $79,000 left, and then it pays it to its shareholders. The shareholders are taxed again on the dividends they receive. They get a double tax. That's why accountants freak out when you hear about C corporations. However, most people are zeroing out those C corps, right? But if they do issue out dividends, quite often you're no worse off, because you had a 21% flat tax, and then you have a dividend tax which is at 0, 15, or 20% in the United States. So the way you're taxed, you could be zero tax on those dividends. In other words, it makes really not much of a big difference. So what are the biggest tax differences between the three? LLCs, S Corps, C Corps. Number one, and this is huge, C corporations can reimburse their shareholders, their employees, 100% of expenses for health, dental, and vision. Not misstating that. So if you own a C Corp, you have a closely held C Corp, yourself, spouse, maybe your kids, 100% of your expenses, that corporation, or your medical, dental, and vision expenses, 100% could be reimbursed out of the corporation. It writes a check to you, it deducts that, and you don't have to recognize it as income. That's a huge benefit, especially if you have somebody that you're caring for that's your dependent or yourself that has considerable health expenses, dental expenses, vision, even long-term care can kick in. That's why those C corporations are so potent. It's the only one that could do that. I don't want to mislead you. An LLC taxed as a C corporation can do that too, but it needs an 1120, which is the tax form that C Corp files. That's one of the major benefits. The other thing that applies only to corporations and not to LLC taxed as corporations, and it is going to be for corporations, S or C, is what's called a 1244 stock loss. It's only corporations because it specifically says stock, whereas LLCs have membership interests, right? So LLCs don't get this benefit, but what it means is, for example, if you have a C Corp that loses money, and let's say it has $50,000 of losses, and I dissolve the corporation, normally that $50,000 would be considered a capital loss, and those capital losses could only be used to offset capital gains. But in the case of a 1244 stock loss, I can actually treat it as an ordinary loss and use it to offset my salary, my wages, or other income. So that's a pretty big benefit. About 70% of businesses are currently set up wrong. Let's make sure you are not part of that 70%. Please like and subscribe. Share this with anybody that you think would benefit. And if you have comments, please leave them. I do read them and I do answer them. And if you want me to make a video on a particular topic, put it below.